Did you know that one wrong investment move could cost you thousands? Want to know what the most common mistakes are and how to avoid them? We're breaking down the biggest investment blunders that can sabotage your success. Number 1. Lack of research. One of the biggest mistakes new investors make is jumping into the market without doing proper research. Sure, you've probably heard of people making quick money in stocks or crypto, but here's the truth: understanding the fundamentals is key. Many beginners see a company's name or hear a hot tip and rush to invest. But if you don't understand why you're investing in something, you're walking into a minefield. You don't need to be a financial genius to start investing, but a little research goes a long way. Know the company's history, its future growth potential, and its position within the industry. The same goes for other investments like real estate or mutual funds. Spend time learning about market trends, read reports, and follow expert analysis before making any moves. Take your time and only invest in what you understand. Number 2. Trying to time the market. The next trap? Trying to time the market. New investors often believe they can buy at the perfect low and sell at the perfect high. It sounds simple, right? Wrong. No one, and I mean no one, can perfectly predict the market. While it might seem tempting to wait for a better time to buy or sell, more often than not, investors miss out on opportunities because they're waiting for that perfect moment. Market timing is risky business, and it's a game even experts don't always win. Instead of timing the market, focus on time in the market. Historically, markets trend upward over the long term. So, staying invested consistently often beats trying to jump in and out. Patience is the name of the game here. Number 3. Over-diversification or lack of diversification. Next on the list is diversification, or rather, not diversifying enough or going overboard. You've probably heard the saying, "Don't put all your eggs in one basket," and that's absolutely true for investing. If all your money is in one stock, one sector, or one type of asset, a downturn in that area can hit you hard. On the flip side, over-diversification can spread your investments so thin that you end up with mediocre returns across the board. It's about finding the right balance. The solution? Diversify, but do it wisely. Invest in different asset classes, stocks, bonds, real estate, etc., but focus on quality rather than quantity. A well-rounded portfolio with a mix of investments will give you both growth potential and stability. Number 4. Emotional investing. Emotions and investing don't mix well. The market is going to have its ups and downs, and if you react emotionally to every swing, you're setting yourself up for failure. Fear and greed are the two biggest emotions that drive bad decisions. Fear causes investors to sell during downturns, locking in losses, while greed pushes people to chase after high-risk investments, hoping to get rich quick. When markets dip, many new investors panic, sell their holdings, and swear off investing forever. But here's the reality: market drops are normal and, in many cases, even healthy. Historically, the market has always rebounded after corrections. To avoid this, have a clear plan and stick to it. Know your risk tolerance, have an emergency fund, and avoid making rash decisions based on short-term market moves. If you're investing for the long term, you'll ride out the volatility. Number 5. Ignoring fees and expenses. Here's one that sneaks up on a lot of investors: fees. Whether it's management fees for mutual funds, trading fees, or advisor fees, these costs can slowly erode your returns over time. It's easy to overlook fees when you're focused on potential profits, but those small percentages add up, especially with long-term investments. How can you avoid this mistake? Be mindful of where your money is going. Compare fees across different investment platforms, look into low-cost index funds or ETFs, and don't hesitate to ask your financial advisor about the fees they're charging. Every dollar you save in fees is a dollar that stays invested and working for you. Number 6. Failing to rebalance your portfolio. Another mistake many new investors make is setting up their portfolio and then ignoring it. Markets change, and so should your portfolio. Failing to rebalance can leave you overly exposed to risk in certain areas or missing out on growth opportunities. Let's say you invested in tech stocks and they've done really well. That's great, but now your portfolio is heavily weighted in tech, and a downturn in that sector could hit you hard. To avoid this, make it a habit to regularly review and rebalance your portfolio. This means selling a portion of your overperforming assets and redistributing them to other areas. It helps maintain your risk tolerance and ensures your portfolio stays aligned with your goals. Number 7. Not having a clear goal or plan. One of the biggest mistakes? Investing without a clear goal or plan. If you don't know why you're investing, it's hard to make smart decisions. Are you investing for retirement, a home, or a child's education? Each of these goals may require different strategies and timelines. Without a plan, you're more likely to chase the hottest trends or get distracted by short-term gains, rather than focusing on long-term wealth building. Before you invest a single dollar, define your financial goals. Once you have that clarity, create a plan that includes your risk tolerance, time horizon, and how much you can realistically invest. Let's make sure your money works for you, not against you. If you found this helpful, make sure to hit that like button and share it with others who could use these tips. And don't forget to subscribe for more smart investing strategies and financial advice.